Hello, everyone. Today on the Final Bar, I'm joined by Sean McLaughlin from StockCharts. Share with us a particular sector, some names top of mind for him. Overall, the market's in a bit of distribution mode today, although after lunch, recovering about half of the losses from earlier in the day. Small caps continuing to show weakness relative to other groups. We're going to look at the sector movements and focus in on some key stocks at key levels to pay attention to. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the charts, focus on the message that the markets provide about supply and demand, about fear and greed, about investor sentiment and psychology, all reflected in price. And if you look at nothing else to understand a particular ticker or ETF or asset class or group, focus on the chart, focus on the trend, focus on the momentum. I would argue that tells you much of what you need to know to make sure you're positioned effectively. Overall, today we're going to have a great discussion with Sean McLaughlin about the charts that are of interest to him. We're also going to answer some of your questions from the Final Bar mailbag, addressing some issues that have come up with many of you. And it's interesting, as we've talked about this market environment, it's been strength upon strength upon strength. We've talked about this relentless uptrend that just continues to push higher and higher. A day like today feels incredibly unusual because we just haven't had many of these. However, a day like this is really not that severe compared to what could and should normally happen, arguably. In a healthy market environment, you should have some give back days. And arguably, we need much more than this to really digest some of the previous gains we've had. But let's look at the charts and focus on key levels and key signals. We have great guests. I'm excited to talk to Sean McLaughlin here in a moment. Tomorrow, on Wednesday, the 18th, we have Jay Soloff from Investors Alley. On Thursday, the 19th, Larry Berman from ETF Capital Management in Toronto. Then coming up next week on Tuesday, author and trader Kathy Donnelly. On Wednesday, the 25th, Katie Stockton from Fairlead Strategies coming back on the show. Also want to mention the pitch. Our next episode is coming up, I think, the week after this one. I think it's end of next week, so on the 27th. So go to stockcharts.com/thepitch for more info on that upcoming special event. Continuing on with today's market recap, we'll start with a poll. As you probably know, on our live stream page on stockcharts.com, we always have a poll running. We also send them out regularly through social media. And here's what we asked you recently. Know your candlesticks. During a downtrend, you see a small real body, no upper shadow, and a long lower shadow. What candle pattern is this? 67% of you, well done. Final Bar Nation correctly answering a hammer candle. Now, what's interesting is the hammer, the hanging man, the shooting star, the inverted hammer are all very, very similar, which is why I asked you. And the two things that make these patterns different and how you clarify which is basically the shape of the pattern, whether the open and close are near the high or the low of the day, and also whether they occur in an uptrend or a downtrend. So most of you answered either hammer or hanging man, which is the correct shape, where you have the open and the close near the high of the day, and then a long lower shadow, meaning it opened up, traded lower, and then closed back toward the highs of the day. Amazon, by the way, yesterday is a great example of a hammer candle. It's where you opened at a certain point, you traded lower, but by the close, you got just above the open. It really doesn't matter if the open or close are higher, just that they are clustered together at the upper end of the range. There's very limited upper shadow, meaning we didn't trade really above the open and close, but we traded far below it. And if you think about it, it literally looks like a little hammer, which is really why it's called that. Think of it as hammering out a bottom. This is a bottoming pattern, tends to be a reversal pattern. If you would see this during an uptrend, then it would be correctly called a hanging man. That's the same shape, but it happens within an uptrend phase. So this candle right here, if you look around the, looks like the 13th or so of July, I'm thinking, which is right here, is actually called a shooting star candle, where the open and close are near the lows, and you have the long upper handle there. If this, or upper shadow, if that candle happened during a downtrend, it would be called an inverted hammer. So again, in general, those names I think are much less interesting than the conclusion. All four of those are reversal patterns, and the logic is when the open and close are near each other, but you've had some volatility, but it really didn't go anywhere directionally, tends to be a reversal candle. So the chart of Amazon yesterday gave sort of a short-term bounce signal, and it was interesting that it happened right at the 200-day moving average. Today, certainly distributing a little bit further to the downside, and that does not mean anything horribly broken about the chart. That just tells you that at this point, it's still telling you short-term bounce. The low of that day is usually what you use as a signal that the pattern did not work. So if we break below there tomorrow, that would invalidate that hammer candle, suggesting a short-term bottom and indicate potential for further weakness. So thanks for answering the question there. Further with our market recap, so certainly sort of a V-shaped day, similar to what we saw yesterday. While yesterday really accelerated to the upside, today a little more of a distribution. And midday really felt fairly negative as the S&P touched 4420. This is before reversing higher and closing back above 4445. So finished down around 0.7%. The NASDAQ actually led the way a little bit further, down 0.9% for the NASDAQ 100. The mid-cap and small-cap index continued to be worse and underperforming the S&P, with the S&P 600, the small-cap index down about 1.5% today. The VIX, by the way, is back nearing 18 again. This is coming off of the, from the 15 handle just a couple of days ago. Interest rates, really not much of a change there. There's some choppiness there, but in the end, the 10-year yield is similar to where it closed yesterday, so no real movement there. And the dollar index up a little bit with the UUP above 25, but no significant follow through yet. Commodities net negative. Precious metals were better than the average commodity, but still down, with gold at the best, or the best of the worst, or the best of the bad. The down the least, down 0.15%. The rest of the commodity complex down a little bit at 4%, and energy was one of the lower sectors today, down 1%. Cryptocurrencies continuing to roll over a bit, and Bitcoin really rolling over through the course of the day. Ethereum, and you can see from the rest as well, with Bitcoin nearing 45,000 again as we're recording the show here. Let's look at a chart of the S&P 500, talk about the big picture. So again, let's not draw too many dramatic conclusions from one day, because one day does not make a trend. A series of days built up over time is what comprises a trend. We've talked for many, many moons about this continued uptrend in the S&P 500. I can throw so many pieces of evidence at you in terms of weakening breadth conditions, which I would argue still are very, very weak, with the cumulative advanced declines not confirming the most recent highs really since July. I mean, July and August really did not signal a higher high, and most of them have made lower peaks and have continued to do so through this week. You've had momentum divergences that really haven't followed through necessarily. And for the most part, anytime we've sold off, the 50-day moving average has remained key support. So it would be 100 points or so to get down to the 50-day moving average for the S&P 500. That's not too much of a sell-off. It's a 3% move down from where we're at right now, 3 to 4%, which is certainly in line with the previous pullbacks that we've had. The steepest pullback we've had peak to trough is around 5, just under 6%, which is again pretty low relative to the average year and the average drawdown. So are we overdue for a pullback? Absolutely. Should we or could we move lower to the 50-day moving average? Absolutely. The real question I think we should be asking is, do we see something going significantly lower than that? Do we see the 50-day moving average not holding? And if so, how would we think about that? That's what I would be considering for your portfolio. And it's not just the S&P 500, by the way. It's the stocks that comprise the S&P, right? It's stocks like Amazon that have already pulled back. It's stocks like Disney that are testing their 200-day. I did not struggle to find stocks that were pulling down to their 200-day moving averages. And a couple of them I'll show you here really quick. That's not Gap, GPS. So a number of these stocks are pulling back to their 200-day moving average. My question for the markets and for these stocks in particular, are they able to hold that 200-day? These are stocks that have already pulled back enough. They've been below their 50-day for a little while. Gap, for example, broke up to its 50-day, tested it, and again rolled over it, closing below its 200-day moving average today for the first time in over a year. As last July was the last time it was below its 200-day moving average. More and more stocks doing that makes me feel less confident about this market being resilient and pushing higher. Disney is right at its 200-day moving average. We looked at the chart of Amazon moments ago with the candlestick analysis, closing below its 200-day moving average again today. Now, some of these stocks like Amazon have, to be honest with you, been sideways for over a year now. These have been long-term sideways trends, the absence of trend. It's been a range-bound environment. It's been more of a consolidation. And I think if we do get a deeper correction than what we've seen so far in terms of price, I think we'll be able to look back at the charts of Amazon at failed breakouts like this as the perfect examples of a sign of a blow off top, a sign of an uptrend that didn't have enough gas left in the tank. This is a pretty high percentage play that it's going to go higher. So we call it big base breakout, a 10-month base. When it breaks out of that on this big up move in early July, that feels like a pretty good indication that we're going to go significantly higher. That was pretty much it. From there, it tapered off and now has broken down, gapped lower, and now back below its 200-day moving average. We've talked about the chart of Apple. And again, this is one that, again, not down a ton today, but overall, all else being equal, seems to be setting up like a very constructive pattern, breaking above its January peak, breaking above it, testing that from above, and now starting to rotate higher. Is it able to hold that and able to move on? What we're seeing right now is actually lower momentum on the move to on the new closing high this week. That's overall sort of a negative signal, a sign of trend exhaustion. So I'm seeing signs of exhaustion on some of these charts. What I'm not seeing is the S&P materially move lower. I'm not seeing the S&P get down anywhere near its 50-day moving average yet. There would have to be a lot more deterioration than what we've seen so far. But again, I'm seeing plenty of signals to indicate it. One last thing I'll leave you with. One of the chart lists that I have is one looking at bullish percent indexes by sector. And a couple are very interesting to me. One is technology, which just broke below the 70% level. This is what's called a bear alert. This is something that's been in an uptrend where, higher highs, higher lows. Over 70% of the index members or sector members in an uptrend. And then it comes down below 70%, which tells you that the point and figure charts of the S&P technology stocks are starting to turn from bullish signals to bear signals, actually triggering sell signals on their point and figure charts. We saw that on the S&P not too long ago, which is an indication of potential top. We're now seeing that in the technology sector just today. We need to take a quick break. We'll be back with my guest, Sean McLaughlin. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using data visualization. A couple quick comments before we get to my guest, Sean McLaughlin. Number one, please send your questions to us. We'd love to hear from you. We're going to do another mailbag segment a little later in today's show, and we would love to answer your question on the air on Friday's show, our next mailbag segment. You can get your questions to us one of three ways: via email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, on YouTube. Just put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions. We'd love to hear from you and hope to answer your question on our next mailbag segment on Friday. Also, go to stockchartstv.com. You can use your email address, set up a free account, start watching all of our great content, fantastic guests like Sean McLaughlin and many others, special events like The Pitch coming up next week, and all of our great other shows on StockCharts TV. Go to stockchartstv.com, or on your mobile device, just search on the App Store for StockCharts TV on demand. I want to welcome on today's guest, Sean McLaughlin. Sean's the Chief Options Strategist at All Star Charts, coming to us from Colorado. Sean, welcome back to the show.
Hey, David, thanks for having me. I love being here.
Appreciate it very much. Now, we've talked about this market continuing to be in an overall uptrend, obviously a bit of a pullback today, but still overall in undeniably sort of a bullish phase. You starting us with a sector, the financial sector, which certainly emerged in a position of strength. Start us here. What are you seeing?
Well, you kind of mentioned it in your preamble there, talking about all the stocks you're seeing in the sectors you were watching. There is some uncertainty out there. People are starting to, be a little bit concerned if there's any more gas left in the tank for the bull market. And, there's a lot of mixed signals out there. And when the markets are offering mixed signals, the guys here at All Star Charts, what we love to do is we like to really take a step back and try to take in the bigger picture. And this chart right here is a perfect example of a big picture. We got 20 years of data right here in front of us. And I mean, look at the financials. The financial space has broken out above a 14 or is that 16-year base. I can't even do that math. It's a long one. And I'm not saying that the financials breaking out of that 16-year base is the all clear signal that we need to go in and get heavily bullish here. But it's hard for us to get really firmly into the bear camp when you see financials breaking out the way they are. I mean, financials are a big part of the U.S. economy, as we all know, heavily weighted in a lot of indices. It's really hard for us to get really bearish here. And this, if nothing else, it makes me optimistic that, yeah, the market's going to work itself out. We're going to have some sideways churn, which is kind of normal for an August, right? But once we get through that, financials are tipping their hat that there's another leg higher coming.
It's such an interesting chart. I love the long-term history that you're showing us, Sean, and you mentioned it, right? You're seeing strength of financials. Now, there have been charts within that sector, something like, like Moody's or S&P Global are charts that have been in long-term uptrends, but your second chart is showing us that it's not just a small number. It's some of these larger mega cap banks, brokers that are breaking out. Talk us through these.
Yeah, so this chart's a little bit out of date. I sent it to you a few days ago, so it doesn't reflect the recent last couple of days pullback. But the trend still remains that Wells Fargo, Goldman Sachs, Morgan Stanley, big household banking names are above recent resistance and are pressing up at or near 52-week highs. And my friend JC at All Star Charts likes to say, how bad could things be if Wells Fargo is making new 52-week highs, right? So look, I'm an old school trader. You've been around a long time. I've been trading since 1998. And one thing I've always known is that most bull markets, you're going to have the financials participating and often leading. So when you see big names like Wells Fargo, Goldman Sachs, Morgan Stanley, and more breaking out, it's hard to make a bearish case here.
So it begs the question then with some of these charts, and you're absolutely right. I'll bring up a current chart of Wells Fargo just as an example. So, obviously a lot of these had really good runs, pull back a little bit, but a lot of things certainly have. Is there something that you would see on these sorts of charts or more broadly speaking on the S&P that would tell you, all right, we now have to start to worry? I totally get the argument. How bearish should we be if something like Wells Fargo and others are breaking out? That is absolutely agreed. What would you see on this chart? Or are there particular levels on the S&P or a signal that would indicate that this is starting to get a little more painful and you want to be getting defensive? How would you think about that?
Well, one of the things that we pay attention to at All Star Charts is we like to pay attention to stocks making new 52-week lows. When we see the new 52-week lows list rising and getting above, recent trends, that is always a red flag for us. And it's a time when we'll start really looking through scans and looking for the weakest names out there to see if they're offering any clues that there could be some further downside coming. And to be honest, we have seen a rising number of stocks making new 52-week lows. We're certainly not at red alert territory, but it is something we're keeping an eye on. And when I say we, I mean the other guys at the team, that they're the true experts at technical analysis. I'm just the lucky guy that gets to cherry pick all their best ideas and do options trades.
No, I totally appreciate it very much. And it's interesting, the new lows, as you mentioned, we've not seen a ton of them yet, but you're starting to see them. And especially, honestly, on the NASDAQ, right? You're seeing a lot more new lows. And we only have about 30 seconds left. But I'd love to ask in particular, on technologies I mentioned just before the break, starting to roll over, and you're seeing stocks that had been, working, potentially showing weakness. So if you think about strength in financials, are you seeing weakness in something like technology, more of the growth areas of the market? Or how do you think about tech in particular in the NASDAQ?
Well, I mean, the tech is weighing, especially in the mid to smaller cap names. We have seen, if not outright bearish activity, certainly some weight weighing down the markets. But I got to be honest, David, if anything, we're seeing it more in the retail space. The XRT, the ETF that we follow for retail, we have a bearish trade on in that right now. And we feel like that could be a real harbinger of things to come. If the market truly does want to offer us a significant pullback here, we think that the retail sector may lead the way.
A lot of earnings in some of those names this week in particular. Sean, listen, thanks so much for coming on. It's awesome to have you on as always. Appreciate you sharing your point of view, sharing some charts with us. Be safe, stay well, and we'll talk to you soon.
Thanks, David. Always fun to be here.
That's Sean McLaughlin. Sean's the chief options strategist at All Star Charts, and I love the way he described it. We're looking at the chart of the financial sector, looking at some of the mega cap stocks like Wells Fargo, Goldman. How bearish do you want to be when these charts are going up? And I know Sean and JC Peretz, who we mentioned as well, do a really good job of challenging with those sorts of that sort of thesis. I think that's really well laid out. Retail, I mentioned a lot of interesting earnings this week. I know tomorrow, I mean, obviously you have the big box retailers this morning. We had Home Depot, Walmart, tomorrow, TJ Maxx, Kohl's, Macy's, all kind of coming out this week. So could be a very interesting space to watch for sure. Let's continue on with today's show with the Final Bar Mailbag. As I mentioned many times, shoot us an email with any questions that come up as you're analyzing your own charts, things you're seeing or hearing elsewhere when you're trying to analyze your own stocks and ETFs, questions that come up during that process of technical analysis. We'd love to answer your questions and point you in the right direction. Shoot us an email, thefinalbar@stockcharts.com. Attach a chart if you can. That always makes it easier to understand what you're asking about, and we'll do our best to point you in the right direction. Question number one, I wonder if you could look at the LMACD, the LMACD, the logarithmic MACD, for looking at an exponential asset like Bitcoin, BTC USD, on a weekly chart and compare with the traditional MACD and PPO. So I am familiar with the logarithmic MACD. I've not used it, and I will tell you why. I think when you're looking at MACD, and as I'm talking, I'm going to try to bring up the chart of Bitcoin, and I'll show you what I mean. You bring up a very valid point, which is when you look at something that's super volatile, like Bitcoin, like a lot of the cryptocurrencies. And to be honest with you, I came to this realization not from cryptocurrencies. This is a pre-crypto thing. I came to this when I was looking more at small cap stocks, relatively illiquid names, stocks that were less liquid and more volatile, less consistent price data. And the MACD indicator would be really difficult to use. I'm looking at daily data here, so not exactly what you asked, but I think it illustrates the point very well. I have Bitcoin here at the top. I'm looking at MACD and I'm looking at PPO. What you are asking is basically, the logarithmic MACD, which is basically looking at the MACD but using a log of the prices instead of using the actual prices. What that does is it addresses the volatility concern. So if you look at where Bitcoin is trading now, because MACD is based on price differential. So how many price points is the first moving average from the second one? The 12 minus 26 day exponential averages are what my settings are telling me. And that's what the black line represents. So the problem is it's fine for right now. But as you can see, when I go back to when there was a smaller price range, because the price range has changed so much, going from the single thousands up to the tens of thousands, the MACD indicator is almost unusable back here. Now, if you go back and look at the time, you'd actually be able to use it just fine. But when you're looking back over time, it's actually very difficult the further you go back because it's had such a change in the price range that it's at. You can see that the PPO, and I would say the logarithmic MACD do a different adjustment, but they try to adjust for the same thing. The PPO actually adjusts for that or accommodates for that by taking percent changes instead of price changes. So an equal percent is kind of weighted the same. It's doing the difference in percentages, and as a result, you can see that the data series on the PPO is much more consistent. You can look back and see what the signals are telling you over time, whereas the regular MACD is not able to do that. The logarithmic MACD basically takes a log of the prices instead of the prices, and I think it tries to accomplish the same thing. So I do think using MACD in this situation is not super helpful. I use PPO. Logarithmic MACD, I don't think it makes a huge difference, but PPO is the one that I'm familiar with. It basically accommodates for that change in price range and adjusts for the extreme volatility in cryptocurrencies. Really good question. Next question: what can I learn from HYG and LQD? Great question. Let us look together. So, when you think about bonds, when you think about the fixed income market, there are a couple different ways you can do it. We tend to look at the TLT, which is basically looking at the long bond. It's an ETF that tracks the long bond, the treasury bonds, the long end of the treasury curve. So these are government issued bonds. When you're talking about LQD, these are corporate bonds. So bonds not issued by the government, but issued by particular companies. You can combine those two and mash them up and look at something like the HYG, which looks at both treasury bonds and corporate bonds. HYG, you're actually looking at high yield bonds. So it is basically the corporate debt of relatively risky companies. Think of it, and again, this is not a perfect example, but kind of like looking at the small cap index versus the large cap index. You're looking at smaller, riskier, higher risk, higher beta types of stocks when you're looking at the small cap index versus the S&P, which is more of the large, established, blue chippy, mega cap types of names. And you're kind of doing that thing when you're looking at the LQD, which is going to be more liquid corporate bonds, more established companies in general, and the HYG is going to be more higher risk types of things. So just like we would look at small caps versus large and look at what people are doing on the riskier side of the equity spectrum versus the more conservative, you can do the same thing looking at the HYG and versus the LQD. So what conclusions can you draw? Well, the fact that the HYG has not made a new high since the beginning of July, you can see that here. While the overall market, the HYG is going to match more of an equity return profile kind of thing, because you're basically taking on a little more risk. The whole idea of treasury bonds is it's very low risk and relatively low return, right? It's a super, they call it the risk-free rate. I mean, it's basically as close to a risk-free asset as you're probably going to find. Whereas something like HYG, you're taking on additional risk, and as a result, you ideally have the opportunity for greater return, or else why do it? And so in general, the HYG tends to look a lot more like an equity index. It tends to track something like the S&P a little closer than bond prices, because it's a kind of like an equity-like bond type of profile. So the fact that the HYG has not made new highs basically tells you that people are taking the bets off of the riskier side of the fixed income side and going more toward the more conservative side. Really hasn't broken down a ton though, but I think breakdowns on the HYG, particularly breaking down through the July low, would be an interesting sign, along with stocks that are breaking their lows, stocks not holding their 200-day. That could continue and give you an indication of relative weakness. That was a long-winded answer, and sorry for that, but I hope that helps you understand it. Thinking in my head as I'm talking, I think that might be a subject of a good webcast or a special event at some point to explain that in a little more detail. Last question here. This might be a tricky one because you asked about a particular asset, and I'm going to bring it up. He basically said, I'm seeing what appears to be sort of market manipulation. I'm certainly not going to agree with you that that is what we're looking at, but you asked about a particular pattern, which is the fact that stocks opened way down with no catalyst, and then immediately rebounded in the first 5 minutes. I'm assuming that's institutional action designed to take out and accumulate those trailing stops at a discounted price. Oh, interesting. So you're seeing the market gap. You're looking at an intraday chart. You're seeing the market come down very quickly, and you're saying, are those institutions that are trying to take out stops? I think you're thinking a little too much about what an institution might be trying to do. If you see also in your question, there's a volume spike at the end of the day, and that is indeed where institutions tend to be putting a lot of their trades. As an institution running a large amount of capital, you try to minimize your impact on the market. The way you do that, part of it is by laying your trades in at the end of the day to minimize the impact during the trading day. And I think that's what you're noticing in the beginning. That's actually more retail investors more often than institutions. They would tend to stay away from that first item. We're out of time. I'll come back to that question on Friday and try to answer it in a little more detail, but we need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at consumer discretionary versus consumer staples. This is one of my favorite ratios to look at risk on versus risk off within the consumer sector. The equal weighted version is at the bottom. The cap weighted version is at the top. You can see the cap weighted and the equal weighted getting very close to breaking down of lows over the last couple of months. I think that's a key chart to pay attention to, particularly my guest, Sean McLaughlin, talking about retail stocks as an area to look. I think that would impact that ratio for sure. Chart number 2 is the bullish percent index for the technology sector. We talked about how for the S&P, we had a bear alert where it rotated below 70%. It kind of creeped back up here over the last week or two. The technology sector just today breaking below. The energy sector actually just broke below 30%. Those are key indications to watch for potential weakness. Finally, we talked about the candle chart of Amazon and getting that hammer candle right at the 200-day moving average. in general, that tends to be a good bounce indicator, indicating short-term strength. We're not really seeing that today. We're seeing further deterioration. Breaking below 3,200, below the low from yesterday, would invalidate that and continue this stagnant chart of Amazon.com. Folks, that's our show for today. Thanks so much for joining us every weekday after the close. Special thank you to Sean McLaughlin from All-Star Charts, joining us from Colorado. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.